Hi everyone. Welcome to our strategic performance review of XCMG. Today, HDIN Research will provide an objective analysis of the group's financial standing and operational progress, covering the full year of 2024 through the third quarter of 2025. Our goal is to examine how XCMG is navigating the current industry cycle and its transition toward a more digitized and globalized footprint. Starting with the core findings, XCMG has demonstrated notable top-line resilience. By the end of September 2025, operating revenue reached approximately 89 billion RMB, representing a 16.3% year-on-year increase. Despite sector-wide challenges, the group's gross margin has remained stable at 21.86%. Most notably, we observed a dramatic 211% surge in operating cash flow, suggesting a strategic pivot toward higher quality collections and tighter inventory control. In the global context, XCMG maintains its position as the world's fourth-largest machinery manufacturer. While the gap between the top tier remains, XCMG has aggressively expanded its international infrastructure, now covering over 95% of Belt and Road countries. The industry is currently shifting from a volume-centric model to one defined by technological differentiation, and XCMG's global dealer network is key to this transition. However, the landscape remains complex. XCMG faces two significant structural hurdles. First, the accounts receivable burden stands at 57.2 billion RMB, largely due to liquidity constraints in domestic real estate and infrastructure. Second, the asset-liability ratio remains elevated at 72.4%. These factors place considerable pressure on short-term liquidity and financial expenses during this market adjustment phase. Breaking down the revenue mix for 2025, construction machinery continues to be the primary driver at over 86%. However, we are seeing a diversification trend, with heavy trucks now contributing nearly 10% of total revenue. This growth is largely supported by a recovery in exports and a leading domestic market share in the emerging new energy heavy truck segment. Profitability metrics show a steady upward trajectory. Gross margins have improved from roughly 19.5% in 2022 to nearly 22% in 2025. This improvement is not accidental. It is the result of a deliberate shift toward high-tonnage lifting equipment and customized mining solutions, combined with more centralized, cost-effective procurement strategies. The quality of earnings is best reflected in the cash flow statement. We've highlighted the jump in net operating cash flow from 1.24 billion RMB to 3.86 billion RMB year-on-year. This reflects management's prioritization of cash over credit sales, a necessary adjustment given the credit risk currently prevalent in the domestic construction market. Regarding asset quality, XCMG's inventory remains substantial at 34.7 billion RMB, with finished goods making up the largest portion. While 71% of accounts receivable are under 1 year old, the group has prudently increased its impairment provisions to 5.4 billion RMB to mitigate potential defaults within the broader property sector. The group's debt profile shows a total interest-bearing burden of 76.5 billion RMB. Nearly half of this is composed of short-term loans or the current portion of long-term debt. Maintaining a current ratio of 1.23x indicates that while the group is solvent, its financial flexibility is tightly linked to its ability to turn over receivables efficiently. Lifting machinery remains the group's crown jewel. XCMG continues to dominate the truck and all-terrain crane markets. The recent launch of the XCA 4000, the world's largest all-terrain crane, demonstrates their strategy of targeting high-growth sectors like wind power installation, where demand for extreme tonnage units is inelastic. In the excavator segment, volume has stabilized following the sharp industry downturn in 2023. XCMG is successfully moving upmarket with hydraulic excavators designed for large-scale mining operations. This move helps decouple their performance from the more volatile residential construction market. The transition to green energy is a critical strategic pillar. XCMG has secured the top domestic market share for new energy heavy trucks. By forming joint ventures for battery pack production, they are securing the supply chain needed to integrate electric and hydrogen drivetrains across their entire machinery catalog. XCMG's R&D intensity remains high at approximately 4.1% of revenue. The focus is increasingly on bottleneck technologies, specifically hydraulics and transmissions, to reduce reliance on external suppliers and improve long-term self-sufficiency in core components. XCMG is moving from an export model to a localized model. Their quote, 1 plus 14 plus N strategy emphasizes manufacturing and servicing within the target regions. For management purposes, mainland China and Taiwan are treated as a unified domestic market, allowing for optimized resource allocation and a centralized service network. The chairman's project number 1 is a group-wide digital transformation. This involves more than just smart factories. It includes an IoT platform that monitors over 1 million active units worldwide, providing a wealth of data for predictive maintenance and future product design. The financial leasing arm acts as a strategic sales enabler, particularly in capital-intensive markets. With a gross margin of over 28%, this segment provides high-value support to the machinery business while using remote locking technology to manage credit risk on the ground. XCMG's CapEx remains focused on capacity upgrades for high-end products. Major investments in crane smart factories and mining machinery hubs are in progress. While this places pressure on the balance sheet, these assets are essential for the group's high-end manufacturing transition. Operational efficiency ratios have shown stability. Accounts receivable turnover is holding at 2.14x, while selling expenses have decreased as a percentage of revenue. This suggests that digital marketing and channel optimizations are beginning to yield tangible cost savings. To address global volatility, XCMG employs a multifaceted risk management strategy. This includes using derivatives to hedge currency risk across 190 markets and maintaining a strict compliance framework under SASAC oversight to ensure long-term sustainability. Looking ahead, XCMG is positioned to transition from a regional leader to a world-class powerhouse. Success will depend on balancing aggressive international expansion with the need for high-quality, cash-generative growth at home. Their 5+1 modernization framework remains the roadmap for this journey. Thank you for your time today. This concludes our strategic review. If you require deeper market research or more granular data sets regarding the machinery industry, please do not hesitate to contact us at HDIN Research via sales@hdinresearch.com. We look forward to assisting with your research needs.